Okay, a really big budget a week ago. Some of the biggest changes that we've seen, certainly than I can recall. Four big pieces that I want to talk about. I want to talk about negative gearing. I want to talk capital gains tax changes, family trust changes, taxation changes, and then there is a piece on electric vehicles and FBT. Okay, the first one that I don't think anybody was overly surprised, but we've seen a shift and a change on negative gearing, but specifically it is limited to residential investment property. I'll explain what it is. So negative gearing is rental expenses exceed rental income and generating a loss. That loss can then be used to offset salary, wages, and capital gains. The piece that changes is that full negative gearing is only available on new builds. So anything pre-existing, you don't get it going forward. Losses on established properties acquired after budget night are deductible against rental income and property capital gains only. Excess losses can be carried forward to offset against future residential property income. This is going to become a little bit clearer when we talk about the exemptions and exclusions. What is a new build? So dwellings constructed on vacant land, existing properties, so knock down and rebuild, where we've got more than one dwelling going on, knock down and renovations where you don't add. So if you've got a 4-bedroom house that you knock down and replace, it doesn't count as a new build. Now, exemptions and exclusions, this is really important. So if you acquired a property, that's either you already owned it or you even exchanged contracts prior to budget night, you don't have to worry about it. Your current arrangements are grandfathered, they will remain in place. Shares, managed funds, super funds will not be affected by the changes in CGT, and commercial property is unaffected. So if you've got the commercial premises that you're operating your business out of, or if you've just invested in commercial premises, we don't have to take this into account. Traditionally, commercial is less of an issue around the negative gearing because the interest, whilst the interest rates are a little bit higher, traditionally the yield on commercial is significantly higher than it is on resi. Okay, capital gains tax. Here are some really big changes. Okay, current rules, just as a reminder, you get a 50% discount if you've owned that asset for more than 12 months. A third in super funds, pre-CGT assets, so anything that was in place or you owned prior to 20th of September 85 has been completely outside of the capital gains tax net until now. Transitional protection. So the existing CGT and pre-CGT exemption will still apply from whenever you bought it all the way up until 1 July 2027. On 1 July 2027, you do have to get a valuation. Specifically here, I'm talking about things like property. Shares, much easier to value, managed funds and the like, but property-wise, all property, we will have to get valued at 1 July 2027. The new rules from 1 July, so 1 July, 30 June 27 backwards, we've got the same rules. So 50% CGT discount, but from 1 July 27 onwards, instead of having that discount applied across the board, we've got CPI indexation. Now, when you see, I've built on the next slide, I've actually built a calculator so that you can go in and play around with what things might look like. There is going to be a minimum 30% tax rate on capital gains. This bit is incredibly important because in the past, we may have been able to sell assets perhaps in retirement. We may have been able to wait until you've retired, your tax rate drops, and then we sell assets. This is starting to capture some of those strategies and wash those out. We've still got the ability to manage some of the tax over the next sort of 12 or so months. But this is a really, really big change. So that minimum 30% tax rate on capital gains. Pre-CGT asset exemption abolished. Now remember that it is abolished from 1 July 2027 forwards, but not backwards. So for somebody who bought Commonwealth Bank at $3 a share, and it is now at say $170 a share, that 3 to 170 remains exempt. It is from 1 July 2027, $170 perhaps to 180, whatever it is. That bit is no longer outside of the CGT net. It applies to all assets, property, shares, everything. And it applies to individuals, trusts, partnerships. There are no exemptions there. There are some potential exceptions rather than exemptions. So exceptions, age pension and job seeker recipients are exempt from this new 30% minimum. This may, my brain's already ticking over saying, right, if you can get $1 worth of age pension, what does that look like? Let's see where my mind's going. Okay, new resi property. So here we'll be talking about the new builds, knock down one home, put 2 units on, that sort of thing. You get to choose between that 50% minimum or the indexation method. Now this bit's really important. I've built you a calculator because I want you to start to think. So basically go to the main site, click on the tools drop down, and there is one on there called the CGT estimator. Now there's some real subtlety here. When we bought assets that have grown very quickly in value, it might be growth-focused shares, it might be some property, it might be crypto, any of those sort of things that grow really quickly or potentially could grow really, really quickly. We're going to be disadvantaged under the inflation system. But where we've got an asset that maybe generates us more income and the capital growth piece has been slow, we may actually be at an advantage under the new inflation system, particularly if it just grows nice and slowly. Inflation's relatively high. We can actually, I want to say manufacture, but there are scenarios that I've modeled out in that calculator where slower growth, nice income, actually means we either pay lower tax or in some scenarios, no tax. Think about a property bought for $1 million that didn't quite do what you thought it was going to do. And perhaps it grows to say 1.2, 1.25 over 7 or 8 years. In that scenario, depending on your time frame, potentially you could pay no tax on that $200,000 gain. It's not all doom and gloom, but there will certainly be impacts. Have a play around with that calculator. Right, minimum tax on family trust distributions. There is some potentially, particularly if we've got family trusts, if we've got small business where the shares are owned by a family trust, where we've got assets or income coming through a trust and out to a bucket company, there are going to be some changes needed. Okay, at the moment, the way a family trust works, it is a flow-through vehicle. Income drops into the trust and it is not taxed because we always flow through the trust and out to the end beneficiary, be that a bucket company or an individual. It is taxed in the hands of the end user. But the change now says that trustees, so the actual trust itself, the trustee will pay 30% tax on all taxable trust income. So anything coming into that trust is now taxed at the trustee level at 30%. Non-corporate beneficiaries, so individuals, you and I, will receive a credit, a franking credit for the tax paid, but it's not refundable. The practicality here is that there is now a minimum tax rate of 30% on those distributions. So a refundable tax credit or franking credit would be, I don't pay any tax at the moment because I don't own anything. I get income dropped from the family trust into my personal name, but I know I've got a franking credit and it can potentially not only offset any of the tax I'm going to pay, but I may even get a credit back from the government. That now stops. That credit does not apply for corporate beneficiaries. Here I'm specifically thinking about bucket companies. This is where this is really controversial and it flies in the face of the current tax law. But if the money goes from the business, drops down to the family trust and gets taxed at 30%, then it goes down to whatever's left. So say we had $100,000 drops into the trust, it gets taxed 30%, we got 70 grand. If that then goes down to the bucket company, it is taxed again at the bucket company's tax rate of 30%. There is no acknowledgement or no credit for prior tax paid. That one's really controversial. Whether or not it gets up and gets through the legislative process, I do not know. Certainly one to watch. There are already ways to manufacture or manipulate. There are ways to restructure to potentially get very, very similar outcomes. That is something, if you've got this strategy, this scenario running, this is something that I'll be having a chat to your accountant about. 3-year rollover relief from 1 July 2027 for small businesses restructuring out of a trust, minimise the CGT and income tax on the restructure. So there's going to be a change of ownership, but we don't necessarily have to be worried about that. The issue that we don't necessarily have clarity on yet is stamp duty. So specifically here, if we've got a structure that owns property, if we change the ownership of that company, what does that do to stamp duty? The simple answer is we don't know yet, but we're watching it. Excluded from this minimum income, fixed and widely held trusts and super funds, special disability and deceased estates, and charitable trusts. The really important piece is deceased estates. Yes, while it's still in deceased estate stage, but as soon as it passes to a testamentary trust, if that trust wasn't already in place, we've now got that minimum 30%. There's a little bit more to come on that, I think, because in effect, if it is applied as it is written or proposed at the moment, that is in effect, well, it's an inheritance tax, which we don't love. There are some exemptions around primary production. Maybe we got to see the detail on this around vulnerable minors. And this testamentary trust piece, it's not overly clear just as yet, but I want to see what the legislation looks like. FBT on cars, this is a phased approach, so full FBT exemption continues to the end of March 27. Phase 2 is 1 April, which is the start of the FBT calendar, for another 2 years to the end of March 2029. The full exemption is if you come in under that 75 grand limit, and then you get the 25% discount above. And then from 1 April 2029, the exemption, the full exemption is removed entirely, and the 25% discount is only from that luxury car tax down. Those are the changes budget-wise. I think the big thing to take away, number one, these are proposals. They have not been legislated. Number two, we do have time in advance of the changes, should they get up. We'll wait and see. Now, there are a couple of things in here that are really controversial from a tax perspective. There are things that I don't love. But one of the, I think the best examples that we've seen recently, really controversial tax law, Division 296, for the application of additional tax on anybody with more than $3 million in super. That stuff got watered down or wound back because there was a lot of pushback. I'm hoping that we're going to see some of that. I mean, you will probably have seen in the media, even Sunrise is getting stuck into the PM over the budget, but we're starting to see a lot of pushback here. I'm not going to pass any comment on the politics of it, but from a tax law, well, let's see what gets up. Just remember that this is not legislated. I'm more than happy to have a chat about worries, concerns, thoughts, feedback on the budget. But a lot of this, the tax structuring is going to be a conversation between you, me, and your accountant. Chat soon. Bye.